Hello everyone, welcome to my channel. Today we will learn about equity. Equity. Introduction to equity. Equity represents ownership. When an individual buys equity, they are essentially purchasing a small piece of a company. This ownership gives them a claim on the company's profits, assets, and future growth. In modern financial markets, equity is one of the most popular and widely discussed investment avenues because it offers the potential for high returns over long periods. Unlike traditional savings instruments, equity is dynamic, market-driven, and influenced by a wide range of economic, business, and global factors. In India, equity investing has grown rapidly over the past 2 decades. With the rise of digital trading platforms, easier access to information, and increasing financial awareness, more people are participating in the stock market than ever before. Equity is no longer seen as a domain reserved for experts. It has become a mainstream tool for wealth creation. Where equity is traded, equity shares of companies are traded on stock exchanges. In India, the 2 major exchanges are Bombay Stock Exchange, BSE, National Stock Exchange, and SE. These exchanges act as marketplaces where buyers and sellers come together to trade shares. They ensure transparency, liquidity, and fair price discovery. Every listed company must follow strict regulations, disclose financial information regularly, and maintain governance standards. This framework helps protect investors and maintain trust in the market. When you buy a share on BSE or NSE, you're not buying it from the company directly. Instead, you are buying it from another investor who is selling. Similarly, when you sell, another investor buys it from you. This continuous exchange of shares creates a vibrant and active market. Equity versus fixed income. One of the most important distinctions in investing is between equity and fixed income. Fixed income. Fixed income instruments such as fixed deposits, government bonds, or corporate bonds offer predictable returns. They guarantee the principal amount and provide interest at a fixed rate. These instruments are ideal for conservative investors who prioritize safety over high returns. Equity. Equity, on the other hand, does not guarantee capital protection. The value of your investment can rise or fall depending on market conditions, company performance, and economic factors. However, this higher risk comes with the possibility of significantly higher returns. This trade-off between risk and reward is the foundation of equity investing. Investors who are willing to tolerate short-term volatility often benefit from strong long-term growth. Historical returns from Indian equities. One of the strongest reasons investors choose equity is its long-term performance. Over the past 15 years, Indian equities have delivered approximately 14 to 15% CAGR, compound annual growth rate. This means that if someone invested 1 Indian rupee lakh 15 years ago, it could have grown to more than Indian rupee 5, 6 lakhs today, depending on the specific stocks or index chosen. Even more impressive is the performance of well-managed, fundamentally strong companies. Many such companies have delivered 20% or more CAGR over long periods. These companies typically have strong leadership, consistent earnings growth, competitive advantages, good corporate governance, sustainable business models. Investing in such companies can create substantial wealth, but identifying them requires research, patience, and discipline. Why equity generates high returns. Equity has the potential to outperform other asset classes because it represents ownership in businesses. As companies grow, expand, innovate, and increase profits, their share prices rise. Investors benefit from capital appreciation, increase in share price, dividends, portion of profits distributed to shareholders. Over time, the power of compounding amplifies returns. The role of skill in equity investing. Unlike fixed income, where returns are predetermined, Equity investing requires decision-making. Choosing the right companies is crucial. This involves studying financial statements, understanding business models, analyzing industry trends, evaluating management quality, assessing competitive strengths, monitoring economic conditions. Successful equity investing is not about luck. It is about informed choices, long-term thinking, and emotional discipline. Many investors fail not because they choose bad companies, but because they panic during market corrections and exit too early. Long-term capital gains and tax benefits. One of the most attractive features of equity investing in India is its tax efficiency. When you hold equity investments for more than 365 days, the profits fall under long-term capital gains, LTCG. Historically, LTCG on equity has enjoyed favorable tax treatment. This makes equity more appealing compared to other investment options where interest income is fully taxable. For long-term investors, this tax advantage significantly boosts overall returns. The importance of long-term investing. Equity markets are volatile in the short term. Prices can fluctuate daily due to news, global events, or investor sentiment. However, over long periods, markets tend to reflect the true value of companies. Long-term investing helps you ride out short-term volatility, benefit from compounding, capture the full growth potential of companies, reduce the impact of temporary market corrections. Investors who stay invested for 5, 10, or 20 years often see far better results than those who try to time the market. Risks in equity investing. While equity offers high returns, it also carries risks. Market risk. Prices fluctuate due to economic or global events. That business risk. A company may perform poorly or face competition. The liquidity risk. Some stocks may not have enough buyers or sellers. Emotional risk. Investors may panic and sell at the wrong time. Understanding these risks helps investors make better decisions and build a balanced portfolio. How beginners can start investing. For new investors, equity may seem intimidating, but with the right approach, it becomes manageable. Steps to begin. Open a demat and trading account that start with large cap or index funds. Invest small amounts regularly. Avoid chasing quick profits. Focus on long-term goals. Learn continuously through books, courses, and financial platforms. Beginners should avoid speculative trading and concentrate on building a strong foundation. Equity as a wealth creation tool. Equity is one of the most powerful tools for building long-term wealth. It has consistently outperformed traditional investment options like fixed deposits, gold, and real estate over long periods. For young investors, equity is especially beneficial because they have time on their side. By starting early, investing consistently, and staying disciplined, anyone can build substantial wealth through equity. Conclusion. Equity investing is a journey that combines knowledge, patience, and long-term vision. While it does not offer guaranteed returns, its potential for wealth creation is unmatched. With historical returns of 14 to 15% CAGR and even higher returns from top companies, equity stands out as a powerful asset class. For beginners and experienced investors alike, equity provides an opportunity to participate in the growth of India's best businesses. With favorable tax treatment, strong long-term performance, and the power of compounding, equity remains one of the most effective ways to build financial independence.